Okay, we're going to get started and let people file in as we go here. I'd like to thank everyone for joining us on a beautiful Cleveland afternoon, evening. The weather is enticing, and I know many of the roads and the highways were slow going, so we appreciate everyone joining us. This is the fourth of 6 Angel sessions, education sessions that we're doing this year, and the topic is boards of directors. As we dig in, we'll provide a bit of an overview up front, as we have with the other sections, and then we're going to divide this up into pieces which include how governance works, essentially representing shareholders' interests, how board members seek to guide companies and help to stay true to the strategies, and then also how board members act as a sounding board for the companies. There are a lot of different ways to organize the information. That's how we organize it. That's how you'll see it up front, and then that's how the panels are also put together. For those of you who don't have our full calendar, we hope you can join us for our last 2 events. One is learning from exits. We're going to have a number of CEOs from the region who've successfully gone through exits with their companies and board members who've been involved, talking about what went well, what didn't go well, what was preordained, what was utter luck. And I think there'll be a lot of interesting things coming out of that. The last session of the year is going to be open to the whole entrepreneurial community as well. There's going to be something of an organized open mic night where we're going to give people, entrepreneurs, CEOs, and also investors an opportunity to get up and share 1 minute of something everybody has to know about what they've learned. As we've gotten feedback and questions, it's just been really interesting what we've heard, and we think that that kind of structure would be a lot of fun. And as many of you know, this is possible because of the support of the Burton D. Morgan Foundation. They've underwritten our ability to host these and to convene groups of angels here. And we'd like to thank the foundation. Vicki Brewer is here from the foundation. Just thank you very much, Vicki, for your support. We'd also like to acknowledge North Coast's Innovation Council. This is a group of companies and institutions that support us, and their support allows us to have 12 member meetings a year, to convene as we do, and essentially apply a structure to the management of the fund. Beyond the financial support we receive, we ask, and that we see many of you here today, we ask our sponsors to attend meetings, to be open to introductions from portfolio companies, and to look for opportunities to work with portfolio companies, both in terms of utilizing their technology and also making connections into the broader community. So far, it's been very successful. There's a high level of engagement, and we thank you all for being here as well. The last thank you is for our panelists. There's a lot of brain power that we've assembled for these panels here tonight. I'll be asking some questions. Many of you, I hope, will be asking questions as well. They know what I'm going to ask. They do not know what you're going to ask, so feel free to ask hard questions. We're asking everyone to give relatively short answers because we want to get as many questions in as possible. And one thing we explained to the presenters on the panels, and we'll mention to you also, is that because it's a large group tonight and because we're recording this, there's the opportunity for us to share all sorts of experiences we've had. And the experiences that come from companies in the region, companies that many of us know. So we're asking our panelists and we're asking you to not mention companies by name if there's a situation or a reference. Many of you may know where some of these experiences came from, but just out of confidentiality and respect to the companies, we'd ask that we keep it at a high level. So at the other educational sessions, what we tried to do was to define the space of company development that we're focusing on, because, for example, boards of directors function very differently at the seed level, the Series A, the Series B, etc. They're constituted differently, there's a different charge, and the types of people and their roles are often very different, often transitioning from individuals to representatives of institutions. So for the purpose of tonight's conversation, we're going to be talking about serving on the boards of early stage companies that are or have recently raised $1 million, $2 million, and are working towards growth, are working towards demonstrating product market fit, and often working towards a Series A financing, which would likely be led by an institutional VC or perhaps another smaller investor group. I assume most of you are familiar with Steve Blank. We like his quote that a startup is not a small version of a large company. John Huston, who many of you know, says a different way that a baby is not just a really small adult. And that is very true of startups as well. It takes different types of people, they operate differently, and the boards have to have different expectations and different approaches in order to be successful. You also have to have different expectations of the outcome, because we know from large numbers of surveys of seed stage companies that at least half of them do not survive past that financing. So many of us who are serving on boards are going to put in a year or two or more to a venture which essentially doesn't go anywhere, right? Which fails. And if the venture goes very, very well, as directors, we may get fired because it's successful, a VC comes in, and we're off the board. That's a good thing, not a bad thing, but the expectation has to be there of what the board member is there to do, who they're serving, and what the expected outcome is. This was something that we looked at in our deal terms session, in our diligence session previously. And this is a survey of over 1,000 seed stage companies highlighting the reasons that they failed. This was based on company-generated postmortems. 2 of the 3 reasons were they ran out of cash and not the right team. Those are things that the board is intimately involved in. And the first, no market need, I would argue the board is also involved in, because the board should be providing structure and guidance and focus to help the CEO find that product market fit, or at least create the conditions under which a CEO and his team or her team can find the right product mix. And a lack of that type of fit often comes back to actions that the board has the ability to influence. So 4 general outcomes, a simple 2x2. Either everybody can do well, investors and entrepreneurs, everybody can do poorly, or one group can win or the other can't win. As an effective board, that means that not only does a company have to be successful in the end, but there have to be structured financings, ideally that have up rounds, managed dilution. There'll be a lot of dilution in successful cases, but managed dilution as we go forward. And again, on the expectations side, the only thing worse than participating in a company where it fails, when you're the director, is having to bury the body after it fails. And many times as directors, we have to do that. We stay engaged with the companies long after it's clear there's not going to be an exit for everyone. And that's part of the wrap up. It's part of why this is hard. It's part of why some people would much rather be observers than directors on a company. And it's hard to blame them. Representing a fund, and as our members do who represent funds with fiduciary responsibility of the fund, I think we have a little bit of different responsibility, hence our involvement till the end. So I'm sure everyone here, most people here have been involved with a nonprofit board. For those of you who have not been on the board of a startup, we provide this example here just to show how different it is. The typical nonprofit has well over 20 people. A startup board typically has 5. Publicly traded company boards are somewhat in the middle, but the distinction here really is that the people on a small company board are intricately involved in a lot of stages of the company and a lot of details that members of a nonprofit wouldn't be. Sometimes they're compensated. This is something where there isn't necessarily agreement in the early stage community. We like to see angel investors receive a small amount of equity, usually less than 1%, for the time and energy they put in, and so that there's alignment. But there's never cash at an early stage because cash is precious. Boards are typically constituted, as I mentioned, at 5 people to start. Can be as little as 3, as many as 7. Things get more complicated with 7 simply because it's harder to schedule, it's harder to get people in a room. In the 5-person construct, typically there are 2 people from the company, 2 investors, and 1 independent. We'll talk a little bit more about the independent. And traditionally, the boards have looked like this, a bunch of middle-aged white guys. And I don't have anything against middle-aged white guys, I am one, but I think we all now have a better understanding of the importance of having a balanced board, a group of people who bring different perspectives and also just different insights. That's a challenge that we work through. The startup community has a number of challenges, I think, in terms of inclusion. The investment community certainly does as well, but it's something that we are aware of and working to improve. Northeast Ohio is different than other parts of the country, I would argue. There are not hundreds and hundreds of venture capital funds here. There are not thousands of experienced individual angel investors here. So when we get on the board of a company, typically there's a little bit of a different expectation. I think we would hope that companies could raise money nationally. In many cases, though, serving on a board could last 2 years, 3 years. I've been on one board for 9 years. The company is actually progressing quite nicely, but that's a very long term, and that's more indicative of some of the companies in the Midwest. It's not becoming a lifestyle company. These are companies that have raised capital, that have had up rounds, and that have increasing valuations. It's just that they're not in an institutional venture capital path. Our hope is that we'll get more companies in an institutional venture path in a high growth trajectory and have a shorter period, typically where we're focused on the early seed stage activities. So again, these are the 4 primary buckets that we're going to focus on. And the first thing I'll mention is duty of care. So there are 2 details we'll dig into: duty of care, duty of loyalty. The duty of care essentially is a fiduciary responsibility to pay attention, to show up as a director, to read the materials, to make reasonable business judgments based on what you see. If not, not only are you doing a disservice to the company, but you can be sued and found liable. My understanding as a non-lawyer is that it's a pretty easy bar in terms of demonstrating that there is engagement, demonstrating that there is a best effort put forward, and that there's a reasonable effort. But it's something to know that showing up for board meetings, coming prepared, pushing back when you see issues is something that's not optional in an early stage for-profit board. There's also the duty of loyalty, which can be a little bit more ambiguous, and that simply means that the interests of the company are put first before you as an investor or before any group that you're representing. That is a lot easier to see and understand abstractly than it is in practice, because many times we've all sat around tables where investors are thinking about their interests first versus the company's. And in reality, if a member of our fund serves on the board of a portfolio company, they are legally bound, and we expect them to be making decisions and proposing actions that are in the best interest of the shareholders of that company. We would hope there's alignment with the interests of our fund, but those do diverge, and it's something important for the investors and the board members to understand. So had to get a Yogi Berra quote in here somehow as we talk about strategy and guiding priorities. And the quote here, if you can't read it, is, "If you don't know where you're going, you'll end up somewhere else." And it is not unusual at all, in my experience, to get involved in a board and there's not as much strategic direction as you thought there was, right? As soon as the check clears, you find out some interesting things, right there. Different priorities. People are working on a few more things than they thought. And driving focus, laser-like focus on what we think are the milestones is an important discipline that many of us as directors can help a company with. When it comes to the board meetings, and I think the conversation you'll hear here, we try to keep it at a strategic level as opposed to diving into the details. Many of us are detail-oriented people. Many people here are operators, and it's hard to pull back sometimes to the 30,000-foot level, but that's really what can be helpful for an entrepreneur, not diving in. Staying focused on the key metrics, encouraging the CEOs to develop a dashboard that shows the same metrics month over month that you can actually see and manage, and ideally that are tied to raising the next round of capital. It's not always perfect, but we try to identify what we think are the key milestones for a VC to be interested in, for the next big client to go forward with them, or for an acquirer to be interested. And if we don't identify those up front, there's no chance of actually hitting those milestones. And then lastly, just candid, unbiased feedback is really important. I don't think I'm insulting anyone to say that entrepreneurs in general, and many of us are entrepreneurs, have really happy ears, right? We hear things we want to hear, we take the best aspects of those, we're optimists, and oftentimes it takes someone who's just a little bit removed from the situation to call it out. And doing that in a constructive way is a great service to a CEO. Because being a CEO is a really lonely business, both in terms of intellectually, if you don't have a sounding board, if you don't have people to bounce things off of. Oftentimes the CEOs, they feel that they need to have the answers, they need to project to their companies and teams and boards that they have the answers, and it's a failure if they show up and say, I don't know what to do. And part of the relationship piece, which I think we'll get into in the discussion, is building up enough trust so that there's an openness to talk about those particular issues. And it's also an emotional drain because most of our CEOs have a meaningful amount of their net worth, time and energy. They have kids and family, and many times they have 25 or 30 mouths to feed in terms of their employees. And it's really easy to internalize all that and to develop a lot of stress. And I think our ability to be human with the CEOs and to acknowledge that makes it easier for us to be helpful. Simply as we try to increase the likelihood of success, one of the best ways to do that is by not failing, and the best way to do that is by not running out of money. With the optimism that many entrepreneurs have, it's easy to look past how much money is in the bank, how many months of runway that is in fact, looking at actual cash versus receivables or things we think are coming in, and a board focus on measuring precisely those things can be very helpful. And even the simple questions when you're presented with something that said sales this month were $100,000. Great, how do we define sales? Because there are about 4 or 5 different ways. Some CEOs will say, well, we got a thumbs up, right? That's not a sale. If you at least have a signed contract, okay, that's really good. You could call that a sale as long as you understand the real process behind it, you know when you're going to get paid, that you're going to deliver, and that ideally there's a recurring revenue model behind it. But understanding what is revenue, what is recurring revenue is a big deal, and that's part of the discipline we can help to share. The other bit is around next rounds and exit strategy, and much of this is muscle memory and working with networks, because in the Midwest, very few of the CEOs, especially their first time, are going to have any contacts with national VCs. So if they're going to do it, it's going to be through a network, through a local accelerator, a national accelerator, or all of us. And that's an important part of what we can provide to them via the Rolodex. One of the things that's not super fun to talk about as a director is when CEOs or directors have to be replaced. Sometimes it's obvious. It could be obvious if there's a failing around integrity, if there's an utter failure around performance. Usually it's not obvious though. Usually it's more subtle. And every time we've been through a process where we've decided to bring in someone else, the only thing we've regretted as a group is not doing it sooner. And we tend to hear that from a lot of people. And it doesn't mean that the CEO is out. Usually there's a good role for the CEO within the company as long as they have that perspective. But companies can outgrow sales leads, they can outgrow CEOs, they can outgrow directors. And being able to have those hard conversations and have them in a reasonable way with the CEO helps to preserve the institutional memory of the company and increase the likelihood that it's going to be successful. So nearly every company has a crisis. And I put in the nearly, and then I took it out, and then I put it back in, because I'm sure there's some company out there that hasn't had a crisis, but it's not one of the 50 that North Coast has invested in, and it's not one of the ones that I've ever been part of. There's always one or more crises. You see them coming sometimes they're predictable, sometimes they're completely out of the blue, lightning striking. But as a board member, part of your job is to help the company be in a position where they can weather that storm, prevent the things that are preventable, and react and fix the things that can be fixed. Because every crisis doesn't have to be fatal, but it can be. With that, we will invite our first panel up and talk a bit about representing shareholders. And Daniel is reminding me that I neglected to mention one of the more exciting aspects of the evening, and that is our traditional giveaway, which is Angel's Envy Kentucky Bourbon. If anyone here hasn't enjoyed it, both to celebrate wins and commiserate on losses. We hope you will try it. We are going to have a drawing at the end of the evening. The only thing you have to do to be eligible to win this is to be here in attendance. We'll draw names out of a hat and we will let everyone know who wins. So with that, before we get going, we still talking about the bourbon? Yeah. With that, we'll ask our panelists to take one moment and introduce themselves, and then we'll dive into the first question.
Bennett, currently the principal at Gosling Sleep, which is my own consulting firm. I tend to focus on insurance issues and innovating around those. I'm co-founder of Embrace Pet Insurance that I ran for 14 years and then left it last year with an exit for me and my co-founder. And so at the moment I'm in the process of working out my next big thing.
Thank you. Yep. Thanks. My name is Jonathon Vinocur. I'm an attorney at Thompson Hine, which is a law firm. We have offices here in Cleveland and throughout the state, and New York, DC, and Atlanta. I spend all of my time working with high growth, early and growth stage companies, technology companies, much like those that are funded by North Coast, and as well their investors. So certainly we spend a fair amount of that time in the boardroom. Makes sense that hopefully we can help with tonight's conversation.
Len Pagon, I was the founder and CEO of a local interactive agency called Verlant for almost 20 years, founded it and grew it and sold it about 10 years ago, and about 9.5 years ago left and founded NextSpark. NextSpark is kind of a name for our family office, and or what I call very private equity, and we make investments in a variety of things, but spend most of our time with the portfolio companies, some early stage, some growth stage, and help them scale and grow.
Laura Rich Fine. I am not Scott Flamm, who was supposed to be on the panel. He nicely switched with me. I am a partner at Greece Financial, which is a high-end, conflict-free investment wealth management firm. I was a sell-side equity analyst on Wall Street for a number of years, and so dealt with a lot of boards then. I'm on public company board, private company boards. I'm on a few startup company boards, and I've been on a lot, and I've seen the whole range of everything that you were just talking about.
Okay. Terrific. Well, Laura, we'll give the first question to you. And as the CEO of a startup, forget everything I just said. What does a startup board actually do?
Well, there's what it does and what it should do. So I'll speak from a CEO's perspective. For a startup, you need, I totally agree with you, being a CEO is a very lonely thing. And you're very vulnerable. The most vulnerable you are, I think, is with your board. So you, because of course they can fire you. And so, especially if you have not had experience working with a board like this, you can be very, you come feeling, it's the worst meeting you have every quarter or every month or whatever. And sometimes you don't feel the benefit of it, and those things shouldn't be that way. So a board should be more about supporting the CEO in whatever way is necessary. So whether that's advice or guidance or knowledge, connections, all of those things, but the trust has to be there. I have seen though that that's not always the case, and but I think if you can gain confidence as the CEO, you can guide that more. What I have seen work really well is when the CEO gives homework to the board, because people then are engaged together, and it's not just a let's sit in the meeting and point out the things that don't seem to be going so well, because that's often what happens. You try a lot of stuff when you're in a startup and an early stage company, and they don't work. Yes, there are good things too. So, you can make it a positive thing. I think it's very much the CEO's responsibility to make that happen.
And Lauren, we'll go to this side here. So CEOs are understandably focused on control of the companies because very often they owned 100% of them before we came to the party. And it's a getting to know you process. How do you balance the need to allow a CEO to be a CEO, allow them to lead, while also moving forward with shareholder protections and taking the steps you need to take as a board?
I think I view myself as sort of that helpful person who remembers everything they said when they were raising money and what they were intending to do with the company, and that's to me been the greatest instrument I can use is pointing that out. And so when I had found founders go in a different direction than they said they were going to, just reminding them what they originally had set up the company to do and what they were trying to do and trying to keep them on track and trying to figure out why they're going a different direction. I've never been in a situation where it's been combative at all, but maybe because I don't even notice, which is possible. But I found it to be that I feel like I'm there as a resource, I'm there to troubleshoot, and I feel like it is a safe place where they can try things out for size, but I would never hesitate to come back and say, but you can't do that, you told investors this, you at least have to keep trying this, and if you can't, you need to communicate that. And I think that's the other role I play, is trying to keep them on track for the metrics that you talked about. Can you say that you're on track to deliver on the metrics, and if you aren't, can you explain why you aren't? Everybody knows when you're investing in a startup, things take longer, they don't always work, and I think people know that when they make the investment, but as much as you can try to keep the conversation back to where you started and why is it changing over time, it's a healthy conversation.
Okay. So Len, the honeymoon period is great, right? The first couple months, you're working towards a common vision, and then you start to see sales come in a little more slowly, maybe the hiring isn't happening at the pace you'd like, product and development gets behind. How do you know when to think about and to move forward with a change at the time? Just in your experience of working with startups, what does that collective perspective tell you?
You're talking about changing out the CEO?
Yes.
So, yeah, a few thoughts in the beginning. So when you first join a board, it takes a lot of time to really understand the business and really kind of build a relationship or build a rapport with the CEO. And so one of the things that I've really learned over a number of boards I've been involved with is to actually spend the time with the CEO, and it's repeated time, and also to try to get your hands on as much information, because it's just showing up once a quarter and getting whatever the financials are, and it's a lot of times it's just a kind of a report out. Here we're doing this, we sold this business, this new work, and here's what's going on with the product, and et cetera, et cetera. It's just kind of a report out, and so what you really are trying to do is get up to speed with the business. So it takes a lot of time, and the faster you can get up to speed with the CEO and the CEO getting up to speed with the board, don't underestimate it. It takes a lot of time, and then you're also trying to see what the progress is. And so, in my experience, the knowing when there's an issue is when the CEO isn't really listening and isn't really grasping or having an insight of what's going on with the business. That they just get really excited about raising that next round, and everything's really focused on raising that next round. And they may have metrics, but then you just even sort of poke on the metrics really very softly, and you find out that nothing matches. You don't know really what churn is. You don't know what the acquisition costs are, what the return on acquisition costs, things like that. And so if you just kind of like ask basic questions, and then the board meeting turns into, well, you're on the back of the napkin on the fly trying to figure stuff out. And so when that happens over and over and over, and you're burning through cash, and they don't know when you're going to run out of cash, and they don't have a good team, I mean, you have a problem. And so part of assessing the CEO is knowing what their talents and strengths are, and then making sure that they have good people that are going to complement them, and working with them to make those good hires or get rid of people that aren't working out or aren't really complementing them. But eventually, some CEOs just, they keep burning through cash, and they're not grasping the metrics, and they got people that they're surrounded by, and every quarter you meet, it's some new shiny object that is going to be the solution that they need to spend money on, and they haven't sort of fixed the last thing. So I don't know, it's really, you know, you can have a great product and a great market opportunity, but if you have a mediocre or bad CEO, it doesn't matter. Likewise, if you have a mediocre product and a mediocre plus product or a market opportunity, and you have a great CEO, usually the CEO is going to figure out, they'll pivot the company, they'll hire the right people, they'll figure it out. And so, I don't know if I answered your question, but.
You did, and I think you also triggered some post-traumatic stress disorder from board experiences I've had in the past, so that rings true. That rings very true. So Jonathon, you mentioned before that you've been in a lot of boardrooms, and that's partly why you're up here, right? You tend to be actively involved at the actual board meetings. Help us understand at that meeting, though, who you're representing, right? Because there's a company, there's a CEO, and there are board members. And it feels like the CEO tends to think that you represent them, and in reality, there's a broad scope of interest. So help us understand that.
Sure. So unless the lawyer in the room says otherwise, I think it's and there are instances where that's the case. The lawyer is there representing the company, and especially with early stage companies, it's reasonable to think, it's fair to think that for so long as everybody is sort of swimming in the same lane, everybody is directionally wants the same outcomes, that when investors, representatives on the board ask questions of the lawyer in the room, that the answer is going to be consistent with whatever their objectives are as well. But just as soon as some of those interests diverge, and even if those interests diverge as between the company and the CEO, the lawyer in the room should still be representing the company, and frankly, with all sorts of ethical requirements that are placed on us, I think more times than not we can stay in that lane. The hard thing happens though when we're faced with situations where there's a transaction, for example, and an independent director or an outside director or a director representing an investor calls and says, what is this certain outcome, or how are we supposed to treat this, or how are we supposed to handle this? And it's very easy for me to say, well, we represent the company, you should go get your own lawyer. Well, let's be honest though, as a practical matter, that's also going to really get in the way of the deal, slow things down, and make things impossible. So we try very hard to help guide that process, but at the end of the day, the lawyer there should really be representing the company's interests, and even when that separates, and so much so that there are instances where we have to say, we need a set of lawyers that's going to represent the CEO on its own, or an outside director on his or her own. The hope though is that we're not slowing things down in the process.
Okay. So Laura, maybe you could give us a little color for us on how the dynamic in the boardroom changes when you shift from angels, and in your case, jumpstart representation, to having more of an institutional venture capital group.
Yeah. So the earlier it is, the less formality, I think, is really sort of a more common approach. You might not have very many formal meetings, but tend to meet as needed, or certainly more frequently, and you have, it's probably the founder or co-founders and the early stage investors, and that's about it. The bringing on more institutional capital then for us gave us more structure. We were internally measuring our KPIs and so on, but it wasn't as, we didn't have a nice dashboard or sort of an easy way of communicating it, and so we just sort of smarten up when it came to that. We knew what was going on, it's just sharing it in a way that was useful, like just really for everyone. And the board grew by some outside members, and so adding experts from the outside that can really help is actually can be really a positive thing, sort of expand the expertise that's there. But I would just say the formality, and then just the being a little bit more tight on the I promise this, so and this is what's actually happened. The discipline around it, which I think is a really good thing. And as a company, if you're progressing to that kind of capital, then you should be also progressing internally in terms of your structure and your processes and all of that. So it just helps to forward you as a company.
And Len, there's a lot of conversation at the board level about exits. Oftentimes, you're talking to companies about how their relationship with strategic partners are going, what sort of dialogue there is, and every now and then an LOI comes in out of the blue and there's real activity. How do you go about managing the fiduciary responsibility to all the investors, right, to make sure that this is the right price, that these terms make sense, and react in a way like that when the company may not necessarily be exit ready or prepared?
Well, I think there's a few scenarios, and it kind of depends on the scenarios. If you're early and you're just getting going and you're figuring out the product, and you're figuring out the market, it's probably too premature unless it's something super compelling and you're going to realize work real hard for the next 5 years, and somebody really likes the technology and is willing to give you something very compelling. Usually you want to prove out the product, you want to prove out your original thesis, and have an economic model, and then start to scale the company. And if you're able to do that and prove out the story, then you have to keep having the discussion and evaluating it. But it's always ideal to have a much stronger story, a growth story, and then hire an investment banker and go through a process where you're going to realize the best exit. Another scenario is where, and maybe it's related to the CEO, maybe it's related to the product. It's just things take a lot longer, and so you're doing round after round to support the growth of the company. You're maybe making steady progress, but eventually the group gets fatigued. And so again, you're always kind of having the conversation: is the thesis just around the corner, or is it never going to happen? We're just riding this sort of kiddie roller coaster. And in which case, you need to maybe look for fresh capital and a new partner and recapitalize the business and look at an exit. And so, I think in reality, there's enough work to be done to just there's very scarce resources, and so you really need to focus and try to build a company, prove out the product, and prove out the thesis. Build a great product, build a great company is what you should put all your attention and focus on. When you get something compelling, you should kind of evaluate it and see if it is compelling enough, and maybe that puts you into play or looks at creates other optionality for the business, and you got to take it and maybe you even hire an investment banker still sort of proactively, and you can. We were involved in a company that was local, that was growing. It took us a while to get growing, but then we started growing like crazy, software as a service business. And we had a very large private equity summit that approached the company, and again, very prematurely, and was a very nice valuation. And it was a recap, but they're also going to buy out some of the shareholders too. And I encouraged, and we, the board and the CEO actually engaged an investment banker. We went through kind of a sort of a very abbreviated process, but we still went through an abbreviated process. We added, like, for another month of work, added another 40% value, and we got much better terms, and we ended up still working with the same private equity, but same venture fund, and so that would be a perfect example where we weren't really looking for a partner. We created a lot of value, and so we recognized that, and then sort of did a quick abbreviated process.
Okay.
Todd, can I just come up?
Absolutely.
On one of the boards that I'm on, they keep getting soft overtures, and we keep trying to keep them from getting distracted because they're still at that point where we're measuring almost daily what the cash burn looks like, and we don't want them to get distracted. And so what we've tried to do is get one point person who keeps evaluating whether in their wildest dream the valuation would ever justify making what we think could be a premature sale of the company with how much cash we need to raise and everything else. So it's trying to keep people from getting distracted too when it could be a head fake.
Right.
8 out of 10 times it's a distraction.
Yeah.
Maybe 9 out of 10 times.
And so, Jonathan, you've probably been in more board meetings than all of us. And there's, like any group of people, right, there's a variation of performance. So we'll ask you to be kind here, but how much variation is there between how well boards perform? And are there characteristics you've seen of different boards that we can learn from?
somewhat rhetorical, right? I mean, huge variation. The worst boards, frankly, you said be kind, right? The boards with the greatest challenges and that are the least helpful are those that are really just turned into quarterly investor meetings, where, and this will frequently happen when, especially companies that have raised follow-on rounds with sort of mid-tier investors, they use this as their opportunity to pursue each of their own respective agendas because they're not all headed in the same direction. So those are absolutely the worst board meetings, and I'm sure those would be the worst meetings you would have each quarter. The best board meetings that we're in, frankly, as the lawyers, we say very little because it's almost all about the business side of it, and those are a joy, frankly, because then we just get to watch, the way that the company is navigating. Typically, it's growth across the board, and everybody contributing to that growth and evaluating the sales pieces of the puzzle. Those are the best board meetings. The board meetings where you have unsolicited exit opportunities or investment opportunities, all of those kinds of meetings are can be good, can be bad, but in those instances, it becomes incredibly difficult when folks are not really wearing the right hat. And I guess I would say after all of those board meetings, it's very easy as we sit there to see kind of who's worried about their obligations with respect to maybe a constituency of investors, and who's worried about their obligations with respect to all of the investors. But the best boards are all working together with that that collective and all of the shareholder mentality in mind each day to increase that value. So those are the best boards, hands down.
Okay. Then, Lauren, could you share a couple thoughts on compensation, how you approach it from a board perspective? It's obviously very personal for the leadership team, but the board has a great deal of control, or all the control, in terms of how that works.
Those are difficult conversations, and thankfully most of the situations I've been in, the founders haven't been that greedy. But here they finally gotten some money. They haven't possibly paid themselves for a long time, and they're now really excited. And I feel like my job is to remind them that this money was given to them not to put in their bank account, but to really improve the company. And so that's where the challenge comes in. You usually and I was listening to your comments, in the situations I've been in, I've known the CEO of the company really well. I was there early, and usually do have a relationship where I feel bad sort of suggesting that they need to cut back even though I don't. But I don't want to see that much go to their compensation. I really want the money to go to the business, and I'm very protective as an investor in that case, mostly because in the case of someone like North Coast having to come back and talk about the cash burn, having to talk about all these other things, you don't want the failure to be that this person finally is back to not eating canned tuna fish every night, but you just lost all your money. And so that becomes the real challenge. It's easier to give them non-cash compensation and have their interests completely aligned with investors, but you're constantly trying to balance not diluting all shareholders by giving away too much equity as well. And so I think those are the challenging conversations, but you do want it to be fair. These people are typically working really, really hard, and the ones that work the hardest, I'm kinder to, because you know how hard they're working, and you know they can't spend it anyway, so you can sort of find that right balance.
Okay.
But those are the toughest conversations. It does get very personal.
Great. So one more question, it'll be a free-for-all, then we'll take questions from the group. So whoever wants to answer this question, when you're looking at making an investment or considering an investment, how important is the board? Whether it's an existing board or a board that you think will be constituted, in terms of when you look at whether or not a company is investable in your mind?
I have a mic, so I'll just start, which is typically in the case of startups, you actually have no idea who the board's going to be, and so I would say it doesn't really factor in. Usually my initial decision is based on the idea and the management team, and my assessment of whether they really can both execute, but also that they want to surround themselves with people who want to be supportive, but also can be really challenge them as well and say no. So you don't usually know who the board is at the beginning.
Yeah, my initial response is not a consideration at all. Although after I thought about it, so the number one consideration, and what I've realized over the years, is we're really in the investing behind the CEO. And ideally, you find somebody that's good, that really has a good insight and articulate it, is sharp, and understands the problem or solution that they've created. And so, to me, that's by far number one. I do think the board, sometimes there are some board members, and so who else is involved, and are they going to add value? Is, again, there's a whole bunch of white space, product opportunity, market opportunity, product, all these things are, and who else is on the team are much more important than the board, because you can change the board. But if there's other people that are really smart, that are, kind of have known the CEO, or they know this space, it's definitely adds some seasoning or adds some value.
Great. Questions from the group? Yeah, Mark.
One question that even the whole area hasn't talked about is the role of corporate secretary. I'd just like to preface this that I, on my board, have a tremendous corporate secretary, but I've also taken on the role of corporate secretary for another board of the company I founded. And that was probably one of the best moves for me, is to step down off the board and just take on that role. That way I don't have the burden of being a board member. And my grandfather was a secretary at DuPont, but he's not around, so I can't ask him his advice. What do you see the role of the corporate secretary? Is it an important role? Is it a minor role? Should it interject? What should be the overall high-level view of the corporate secretary and its role on the board?
I feel like you're all looking at me. So to be perfectly candid with early stage companies, and maybe this is just around the definition of corporate secretary, but from a legal board minutes perspective, we're of the opinion that the sole purpose of those minutes is really to serve a diligence function going forward. That we're going to put them into a data room at some point. We're going to say, that people were there. It's going to evidence some amount of governance, some amount of process. But the last thing I want to list in those minutes would be all of those soft overtures about M&A, any dissent in the meeting, et cetera. And so, especially with first-time founders or first-time founders that are subjected to some process eventually, we push them really hard to identify somebody, maybe this is what you're thinking about, who is really going to take real minutes, and that person is going to identify all of the to-dos, the things that need to come back around, and the follow-up items. But from a pure sort of secretary, taking minutes, Robert's Rules of Order perspective, it's not something that we harp on with, with venture-backed companies.
Question on the, you showed the slide, Todd, on the board makeup. You've got the founder, you've got the CEO, you've got maybe the 2 lead investors, but then you've got that 5th, independent. Tell me more about the criteria that when you sat on boards, what was the critical criteria to pick the right 5th person?
Well, I'll just give you one side of it, which is not what you want, which was I've seen on a board basically a friend of someone else on the board, and who showed up and said, "This is great, I'm really going to learn a lot." And it's like, yes, not really. So, but I've also seen, someone who's going to really add value, but able. Actually able to, and I think you want it's what's coming up next, and how can they add value to that, as opposed to they're really an expert in their field, but they don't have any insight into how a small company does this. You wouldn't want someone who was the CEO of DuPont probably coming and being in your little teensy startup, So it just, someone who's going to be helpful in practical matters. That sounds very vague, but there's a big difference between these two. Someone who can actually do something. So.
I've been asked to be the independent director, and in each case it's been because I've had some industry knowledge and a sense that I might be able to help them find new investors, that we're looking at it strategically, so not as a startup, but because they cared strategically about the business. itself because of my background in certain industries. And I think, so it goes right to what you were talking about. I was there for a very specific reason, and also because I play mom really well and keep people on track and know that I really actually do what I'm supposed to do as a board member. In fact, just to have a clear conscience coming here tonight, on one of the boards I'm on that's very much at the beginning, I sent them a note saying, I think you're behind in your communication to investors, can we start working on something? And thankfully, they just had that same conversation with Jumpstart today, so I felt okay about it. But I could come here with a clear conscience and know I was providing that role to them of playing mom. So.
Yeah, I would just,
He doesn't play mom.
I think that, kind of tying up what Laura said, that you need to think about what your strengths are as a CEO and where your blind spots are or what the critical issues are of the company. And the best board meetings are where if people are kind of up to speed, you've already had a number of board meetings, and the CEO is teeing up an issue or an opportunity, and they've done some synthesis, and they've said, here, pricing, we might be not pricing enough. I've studied, related competition, and here's the kind of pricing they have, and upfront fees and service fees, whatever the issue is. But they've teed it up. There's a fair amount of synthesis with what other competitors are doing. They're informing the board, and then you're having a really healthy discussion and debate about that issue. And so, the two things, in my opinion, it's not more than one board, by the way, board member. I think there's a shortage in most of the boards where people are bringing a different perspective that's complementary to the rest of the participants on the board. And so, usually there's a lot more overlap, a lot of finance people and people that are on a more capital structure, whatever. And so I would encourage you to think about what's your strengths and weaknesses as a CEO. What are the big issues that you're facing, and then have the board. And you can have the board be temporary, participants that's going to be there for a year or two, and then maybe the issue is now growth, and you got to find some other board members. But people that are going to have value-added discussions that are going to challenge you and challenge your thinking, and you should welcome that. And so that, to me, are the best, most productive boards and board discussions.
Could I tack on one thing on that? So rare that I need one of these, sorry. The difficulty with the independent director, though, is also it's quite frequently the person who doesn't have some sort of actual interest. So when we do get to the point of an M&A opportunity or even follow-on investment, and you have 5 folks in the room, 2 of them are common stockholders and 2 of them have preferred stock, the 5th independent who was brought in to talk about pricing and the way it works in the industry is now the lady who's stuck also essentially for legal purposes being the person who we're all going to turn to and say, hey, make a decision. So it's actually a tough spot to be in, and one that comes with a lot more responsibility than just the industry knowledge.
The last question to Morris here.
Probably should have started this question earlier. So, I guess my question is, what is the difference in the role that a board plays at an early seed stage versus later on in a Series A or later? Or stated differently, if it's true that a startup is not just a smaller version of a large company, why is there a need for a formal board at all as opposed to just a sounding board to support the CEO?
I didn't mean you should answer.
I'd like to hear it.
Well, okay. I'm not sure that there's a need for very formal, and actually it was more helpful for me to have a more dynamic and smaller group, which I also augmented separately anyway. I had my own personal board of advisors for many different aspects of being the CEO, and I used it frequently. Obviously, boards, if you have funding, you've got to have a board legally, I believe, but I'm not sure, you'll be able to talk about this, what the actual requirements are. And so, I guess it was more of a friendly support, which is what I had hoped, and obviously some guidance. But as you get more organized, then if people feel the fiduciary aspect of it more keenly, and while helpful, they also are very truly representing the shareholders, which can be numerous and varied. So there's a bigger, broader thing that they have to be doing.
Yeah, I would agree with that. I don't think there is a difference. I think it's helping the CEO think through issues, and I'm an entrepreneur at heart, and so yeah, there might be other fiduciary responsibility. I wanted people around me that are going to challenge my thinking and help me provide a perspective help me look around corners that I couldn't look around. It didn't matter if they were a formal board and fiduciary. I just wanted the best minds that I got along with.
I would just add, for me, if I'm putting my money into a company, I'd like to be on the board and make sure that it's put to good use and make sure that there's a sensitivity to timing, because in most of these companies there is a cash burn and there is that risk. And I think I can be really constructive, but I can also represent shareholders in that sense, because
If it's
I
a lot of
usually
money, if it's a lot of money, yeah, the meaningful.
it might or might not even be meaningful, but it's more, I mean, in the case of one that I'm on as the North Coast representative, I take it seriously that I might actually have to show up at a monthly meeting and give an update, and I want it to be a good update, and so having a front row seat and making sure I'm keeping things on track, or at least being helpful and problem solving and everything else, so it's a really supportive role, and I would never do it on something where I didn't think I understood and could be helpful.
I think there is a difference in phase, and it has to do with how much money is put to work. And if you're putting in a lot and you're a minority shareholder, that gives you a seat at the table to sort of look after, and not just your stake, but everybody's stake if it's a meaningful amount. If it's early stage and there's just some seed money, it's a different risk tolerance, that you're putting in $10 million or $5 million. You don't want the CEO to be capricious about it.
Great. Please join me in thanking our panel. And we will welcome panel number 2. Sally, since you have the microphone, why don't we start with you?
Intro.
Yes.
Sally Schreiner. I am a Chief Marketing Officer for Hire for startups and scaling small businesses. Prior to that, I worked at Jumpstart as a venture partner, investing in companies in the area. And I also, prior to that, was president of a startup in the area.
Hi, I'm Marc Rosen, Chief Possibility Officer for the Vector Group. Passionate about economic development, love family businesses, and love people that think with a mindset of abundance. Passionate about trying to cure cancer, part owner of the Music Box, and FaceTime my kids every day.
Hi, Dave Lowman. Currently working as a consultant with some companies in town around strategic planning and prioritization for leadership and capital raising. I've sort of bounced back and forth over the years between running companies as CEO, president, CFO, and the consulting work, and I'm also part of the North Coast Venture Fund, both as an investor and an executive member to work through issues as needed by time.
Great, so Dave, we'll start with you. You've been on a lot of boards. What are the characteristics of a great board member?
Well, I think you've heard, as people have talked today, about there's various CEOs and the way CEOs deal with their challenges, and there's various challenges that will be brought upon them, either through internal challenges of the business, external challenges. And I think what really makes effective board members is to be very intuitive around those various challenges. I've worked with CEOs who are very much product people, and the way they think about the world is product centric. And so, in those situations, I try to balance that by being somebody who can bring another perspective that's important to the success of the business to what they're trying to do. And so I think being very much in tune, you've heard people say, and I totally agree with this, you've really got to understand the business. It's just not valuable to sort of apply, well, what I did at this company was this, or what I did at this company was that, without really rolling up your sleeves, meeting with a customer, spending time with the CEO to try to understand, even at the board level, at a more intimate level, what they're dealing with, what the market's like, what the competition competition is doing. Because I think it's that rolling up your sleeves and work that gives you the ability to really bring useful advice to them. And maybe the last thing I'd say, and I heard this on the earlier panel, and I think one of the best environments for board sessions is when the CEO challenges the board to help them with a really meaningful issue for the business. So that you don't just get into a meeting and sort of banter and do the update, but you're really rolling up your sleeves and talking, and pricing was brought up earlier. Maybe it's an offer to buy the business, but get the board to really think collectively about an important issue and get their involvement. I think those are the best sessions.
Sally, just to orient between 30,000 foot view, 5,000 foot view, what is a board-worthy topic and what is not? How do you think about what is even material to be talked about at a board meeting?
So I think we've talked a lot about the check the box type thing. So obviously those are important to do, but typically I think about what is distracting that CEO the most or team the most, and what can you really help them move that out of being a distraction into something meaningful. So that can be, I don't know how to take my sales to the next level, right? I'm having a personnel issue that I need your help talking through. Financing, I think it depends on where the company is, but it also, in my opinion, you're there for a limited amount of time. And so I've had good experiences where CEOs are sending you the packet of materials ahead of time so that you can be looking at your financials and you're not actually reviewing those financials in that precious time you all have together, but you're concentrating on an issue or two and really wrestling it together as a team.
Great. And Mark, as far as strategy of a company goes, how involved do you like to be in just understanding and determining course?
So this is going to be a bit of a contentious answer because I think a lot of board members or advisory board members are very ill prepared because you have to have a quest and a thirst beyond just what they tell you. You've got to learn about what the disruptors are in their business. You've got to understand what makes that business work beyond just the minutes and the updates. And so I've coached people that are advisory board members that utilize people. I think business owners don't have a high enough expectation. And I think the same is true here. I think boards, and I don't mean this disrespectfully, I don't know that they're invested enough. I don't mean in terms of this. I mean in terms of the knowledge and the thirst to want to know enough so that they can be involved in the strategy. Because I mentor a number of companies at Jumpstart, and you run into the problem where you have a mentor that has tribal knowledge and he's prescribing medicine that he or she shouldn't, and you're not a fiduciary there, but you should think of yourself that. So my biggest worry is not the CEOs, are the board people. Let's say they're selected properly. Are they invested beyond, I'm talking about the other capital. So I don't know the people in the crowd, what their experience has been, but I haven't been very impressed with a number of, and I don't mean this disrespectfully, board members that they show up, they provide good input, but they're not really, you can just tell they're not anticipating, they don't understand the drivers of that business. And I just think it's a crime because these poor people have their whole world invested and their families, and I've seen what happens, and it just kills me. So I'm sorry for the long answer.
But Sally, I think related to that, how do you get comfortable that there's enough industry expertise in the room so that smart people and great energy and intentions can turn into actual insights that can be used?
Yeah, so I agree fully that understanding the business, you have to understand, and I think Len mentioned this too, you have to understand the business at the level that you can really give value. So, industry experience, everybody has to understand the industry, right? So if it's getting up to speed, when you become a board member or when you're investing, obviously you're doing diligence on that, finding the right ways to get up to speed. It's a process and an investment past the investment that everybody on the board should have so that they can have those meaningful conversations. I think we talked a a little bit about an independent, bringing an independent to the table who may have connections they can also bring to the table, who may have been there before, but sometimes they're at a much bigger company level. And so this is gonna be a little bit off topic, but I do think people have to understand what that entrepreneur is going through as well. The industry is really important, but it's also the industry at that level of how do you, and having worked for a corporation for 14 years, and it's very different walking in with a brand name and saying, hey, I wanna do a deal with you with this company, than when you're a startup and you're walking in being like, hi, I'm knocking on the door and I'm this person, right? You need people who are helping you also open doors. Sometimes that's industry knowledge, but sometimes that's industry connections as well. But that can be, done by board members, but also can be done by advisory. I think it's also off of a board too, where the CEO can find those connections.
So Dave, on the prioritization side, a lot of value comes from knowing what to focus on, and maybe more comes from knowing what to say no to, or maybe later. Have you found good ways to help CEOs say no, compartmentalize on what really matters, and focus?
I think it's always a challenge as early stage companies. They're everything's an opportunity, right? And a lot of times you're not necessarily sure what your product market fit is completely. I think that an area of discipline that I try to instill in boards I'm involved in is just there really does need to be a plan, a written plan and a budget. And a lot of the companies I deal with, they're pretty sparse. But I think there is a period of time in that last quarter of the year where you've got to lay out, this is who our customer is, this is what we're going to do to go after that customer. Here's the projects that we're going to pursue this year because we think these things will put us in a position to win and to be capital efficient. And then it's the board's job not only to have that plan, but then to review performance versus that plan on a pretty regular basis. It's hard work, but if you do it, the board meetings really change I think, significantly, because now we're not sort of bouncing around. We're talking about these are the 3 initiatives we agreed to pursue. We're on track on 2, we're not on 3. What do we do? How do we get there? What are we off track? And this goes back to your earlier question. Maybe it's a contact that they need in an area, or maybe they don't have enough knowledge within the board itself about the industry. So let's make sure we get together an advisory group from the industry to supplement that knowledge. But I think those are areas where the board is now. The conversation is how do we help you bring the things to bear to execute, and not sort of bouncing around, or what people like to call pivoting today. And then at least at a small company, we like to do that twice a year because that plan, it's going to really be different 6 months down the road. But it's pretty easy to revisit an existing plan and sort of tweak it than to just be operating without that kind of discipline.
So Mark, earlier you mentioned an advisory board as opposed to a board of directors. Tell us more.
Yeah, so I typically facilitate and recruit for family businesses and some startups on the non-fiduciary side. And it's interesting because if you think about it as investors, or you think about it as entrepreneurs, there's a real cool part of having a casual opportunity to really talk through certain issues with the business owner or the team that allows them to be a little bit more vulnerable than I think sometimes in a formal board of directors meeting. And so I love advisory boards. Not a lot of people believe in them. And it isn't about the money, it's about the work. But what I find most helpful is people that do it right learn more, not in the board meeting, but in preparing for the conversations with their team and understanding perspectives that they never would have had because now they're going on stage and they don't want to look bad in front of their team members. So I think advisory boards are wonderful things, but not everybody necessarily either uses it as a compliment or in some cases has it as a substitute. But I find that when it works well, it's magical because I think the principals lower their guard down and they're very willing, maybe not to take all the advice, but you get into some really nice, depthful conversations that otherwise I don't think are on the agenda.
Sally, at board meetings, how much do you like to hear from supporting cast, right? The head of marketing, the head of sales, the lead dev, as opposed to having the CEO really be the conduit of information?
I think it depends. So, you know, most, again, stage of company too, right? So early on, you're really investing a lot in that entrepreneur and that CEO. So it's most important that you continue to hear their growth and development of that business, and how they're thinking about that business too. But they're gonna probably, with this funding, you know, this $1 million, $2 million round of funding, start making some key hires. Sometimes those CEOs are first-time CEOs as well, and so it's important to make sure that you know who their supporting staff are, that they've made those key hires properly and are managing them, and you can kind of coach them through managing as you're seeing them as well. So I'd say it's a balance between that, like shielding those people who are out on the front lines doing their sales presentations or coding or what have you, and making sure you are getting some access to them as well. Especially if there's a key issue that's on the table that is customer feedback. If there is some kind of critical customer feedback that's come in that's changing the strategy, or causing the bouncing around or pivoting or whichever it might be, to be able to talk with folks who have that first line and are responsible for it and may have one of those, key initiatives that's on the roadmap. They're responsible for that, making sure they understand how critical it is for them to be delivering upon that as well.
So Dave, I think as Jonathan alluded to earlier, sometimes when there's an LOI for an M&A event or there's a term sheet for a venture capital funding, alignment can be a little bit off, right, in terms of what's in the best interest of different people in the room.
Yep.
And the CEOs are often in a tough spot because they're receiving a term sheet or a document for either who they're going to work for or who will be helping to divvy up the option pool that they're part of. So how involved should a director be in those kinds of transactions, really on a detail level?
I think, we're talking about, in most cases, pretty early stage companies. So generally a CEO doesn't have experience in those kinds of situations. So I think pretty involved. And one area that I think the boards that I've worked on that have done really well have thrived is that I think those disagreements, the CEO is looking for direction and advice. They don't necessarily need to walk in a high pressure situation and find chaos in the boardroom, and a lot of different agendas, especially with people at the board level sort of working those agendas behind the scenes. So there will be different thoughts in my experience across the board, and I think it's real important in those situations that the boards start to meet outside of the regular board meetings and start to work through some of the differences that they have about what needs to happen. And at least if they are going to present different views at the board level, then do it in a way that's productive and positive and doesn't add more chaos to an already stressful situations. And oftentimes what I found is that boards that do that reach a very strong compromise, kind of a position in the middle that sort of works across the various agenda and now can be really helpful with the CEO as they try to navigate that situation.
Great. So one more question, then we'll go to the group. Marc, how do you help ensure alignment around targets and milestones, right? Oftentimes there's a vision that if a company just does X, they'll be in the realm of a VC round, or if they get to a certain milestone of certain customers, they'll at least be relevant to be acquired. How do you really drive alignment and agreement around those?
Yeah, I mean, I don't know how realistic this saying is to begin with the end in mind, but I think a lot of times you get so immersed in each of the individual milestones, you don't understand what's ahead. And I see a lot of board meetings where you're talking about things in the rearview mirror, not always, obviously, because there's issues. So I think it starts with a discipline that you understand what that roadmap is up front. And I don't know for the people that are in the crowd, because the reality of how businesses move, if those things are as solidified to where you can see beyond the next turn and the next turn, or if it's being presumptuous and you can't, But I think those discussions of understanding what those are have to be put in front of, as a reminder, beyond just the work that needs to be discussed, so that everybody understands what the road ahead looks like.
Questions? You might have answered everyone. Raj, yes.
Well, panels have been excellent and good discussion. And I've been on a number of corporate boards over the years, including 2 companies where I've logged in almost a quarter century each. And one of the things I'd like to point out is that, yes, as a board member, you have responsibility towards the CEO, helping them, towards the company, their fiduciary responsibility, and towards the investors, the owners. So you have those 3 very clear responsibilities. But what I found less emphasized in this compared to my experience is that to fulfill those 3 obligations, you also need to think about the obligation to 2 non-traditional groups. I found that very useful in my work experience. One is the customers. You ought to think about what responsibility do you have to the customers? Are you really providing something that benefits them? To what extent can you improve that? I think the second group is the employees. You need to think about what are you doing for the employees, because without thinking about the responsibility of the company to the employees, you can't really do anything. So I think, just as a comment, I thought those 2 responsibilities were somewhat underemphasized in today's discussion. So I don't know if the current panel has any reactions to that.
You're absolutely right.
I think, I think I talked a little bit about the plan for the business for the year, and I think that's where those things take shape in my mind. It's really important at that point to understand what are we doing for the customer, how do we stack up versus the competition, are we really adding value, what can we do to add more value? And obviously that conversation about, okay, how are we going to accomplish our goals is so wrapped up in who is our team, and are we doing the right things to recruit the right team and retain the right team and train those folks on the business. So I think you're exactly right, but I do think it really comes to the front in that planning process.
Mark?
Todd, you had a slide in your intro, which was the 2x2, and I've been puzzled by one of those, which was investors win, company loses. Has the board failed in that case?
I think so. So I haven't seen a lot of those situations. However, the worse things get, the harder it is to bring on capital from investors. There are often times where the only way you can get a bridge around is to have a 2x liquidation preference, meaning that investors have to get 2 times their money before anyone else gets anything. And it's possible to see liquidation stacks where a CEO might well sell a company for $20 million and receive nothing. Now, I think it's the board's job at that point to come up with a plan and to carve out and properly incentivize the team to move forward with it. But I think if things don't go well, the money you raise can really be an albatross and can hurt everyone's effort, but will preserve some value for the investors. Chuck?
Marketing question. I just have the general sense that oftentimes startup businesses don't have quite the marketing focus that you might recommend. Do you have any recommendations and experience in marketing? And I know, Sally, that's your thing.
You're right. It's we were just talking a little bit earlier, Dave and I, about it's very rare that you have a founder who is a sales and marketing founder that starts a business. A lot of tech founders or scientists that are starting businesses or other, and so it's a huge gap, which is kind of why I started my business. But a huge gap, but in many startups in those stages, to have, they'll be like agency, I'll go hire an agency, very expensive, overpay for what they need, and sometimes they can't select the right agency for what they need because they don't know what they need. I've seen lots of companies who will dabble in marketing and then they say, oh, marketing doesn't work because they haven't approached it properly. So talent is the biggest, lever that they have, except then sometimes that's in fact, one of the companies I worked with, it was like, I need to find somebody I'm gonna give all my money to have a person come in. And then they have no working marketing budget because they've had a person come in. So there's a real balance of, how the investors can help them with talent, getting some talent on board part-time, that's kind of, it is what I do, is go in and help with part-time, find resources, match them with the right resources, but also come up with that plan. How did you, sitting down with a CEO and saying, so you have, 20 customers, how'd you get those customers? And thinking about that process too of sales, is it repeatable? How much was your acquisition for that? How well do you understand your customer? That's all the real fundamentals of the marketing side is, understanding where are they looking for options like yours, who's your competition, and understanding all of that up front. But eventually it is, they need capital. And as you scale, you need more capital, because competition will come along. If it's not there, they will figure out how to squash you if you're not prepared.
Great. Well, thank you very much, panel number 2. We appreciate your thoughts and insights. And we'll welcome our final panel of the evening. Start with the intros.
You're at the end. I'm Dan Rose. I am a entrepreneur operator. Last 25 some years, co-founded 4 different companies, had 4 different exits. I now teach down at Ohio State a class, and I'm in stealth mode for another startup. I guess I can't quite kick the habit. I'm excited about that. I'll unveil that in about 3 or 4 months. There's a couple of people in the room that know a bit about it, but I'm staying below the radar. And I also consult for EOS, the Entrepreneurial Operating System.
Good evening, I'm Scott Flamm. I'm a physician at the Cleveland Clinic. I run this section of cardiovascular imaging, where we do nothing but CAT scans and MRI scans of the cardiovascular system. I am not an entrepreneur, but I certainly have a bug through being interested in so many of our portfolio companies and have been involved as an angel investor and consultant to a number of medical and device companies across the United States.
My name is Morris Wheeler. I have founded and exited internet companies and other tech companies. I ran for a long time and exited a public company that I was the CEO of. And over the past 7 or 8 years, have had a couple of different venture funds where we've made over 80 early stage, predominantly seed and pre-seed investments, and never once served on a board of directors for any of them because I don't believe in boards of directors for early stage companies.
That's why you're here. So, Morris, we'll start with you. And before we talk about serving as a sounding board, who should be in the room in the first place, right? Who has the right to ask for and get a board seat in these companies?
If we're talking about an early stage company, nobody has a right to ask for and get a board seat. Those who get the board seat should be chosen by the CEO as those people who can do the most good for the company and add the most value to the company. In my view, the idea that a board needs to oversee and run a company at an early stage is absurd, in part for some of the reasons that were pointed out by, I'm spacing out on his name now, but the gentleman that was up here before, who talked about a board member doesn't have the time, no matter how much industry knowledge they have, they don't have the knowledge that the CEO has, and no matter how much money they've got invested, they shouldn't have invested unless they believe in and want to support the CEO that they're supporting. So in my view, there is no such thing as having a right to a board seat in an early stage company. There is only the obligation to support and mentor the CEO, and so nobody has a right.
Does that change at the Series A level in your mind?
Yes, yeah, at the Series A level, you're dealing with, first of all, by the Series A level, the level of ownership by outside investors and by the founders is closer. You know, at a seed level, in a properly done deal, the founders are going to own 60 or 70% or more of the company. At a Series A level, there is a greater deal of ownership by outside investors, and therefore a greater need for the board members who represent all shareholders. There is a greater need for representation that comes from the outside group. Moreover, the fiduciary obligations of investors at the Series A stage are typically a little bit different than most investors at the early seed stages and earlier.
Okay. So Scott, to have a good relationship with a CEO and for there to be this sounding board relationship, it has to be a two-way street. How do you help ensure that a CEO is open and willing and candid, right, to engage in that kind of dialogue? Whether, to Morris's point, whether you are a board member or simply an advisor and someone who's seeking to help the company.
I guess I will fall back on, is Marc Rosen still in the room?
That's what he said. It was Marc Rosen.
Stepped down. I clearly heard from him, although he didn't actually say it, but it is really critical to have good relationships. And that is getting to know that CEO, and the CEO getting to know all of their board members or advisors. I'm on the board of a couple of companies now, and one, I didn't know the CEO all that well to begin with, but it was really critical early on to get to know that person, to develop a relationship, to go have a burger and a beer and learn what their passions are, what they do outside of work, because these are really basic human interaction things that if you don't have that as a baseline level, you're probably not going to get to those second levels and have that CEO, that person talk to you about what is really going on with their company, what are the concerns, the fears that they have, the issues that they're dealing with. And so again, wrapping up, this really, I think, comes down to having a very good relationship with them, and that's not simply in the boardroom or basic discussions about the company, but learning more about them as an individual and sharing with each other. And then they're much more likely to be open and more vulnerable with you and appreciative and be willing to accept advice and real discussions.
So Dan, to be informed, what sort of data, information, insights do you want to see regularly, and how do you set that expectation up front?
So at a high level, the simplistic answer is you want to see information that will allow you to steward and govern the company the way that you're entrusted, and you need it in a timely manner prior to meeting or being able to act upon it. That's a pretty fundamental sort of table stake issue that any board needs to have, and unfortunately most of us that have served in board capacity, that is not the case, right? Because sometimes you get it when you're showing up. So that's a core basic. In context, and Todd, you mentioned this in the preamble to the previous question, you want to have open, honest, vulnerability in the CEO that you're working with, so that you know the data and information that you're even receiving is not only accurate and true, but hasn't been doctored or jury-rigged in some way. This isn't a performance that the CEO or others in management are giving to the board so that they can push the rock down the road 90 more days and tread water and figure out what they're doing. So open, honest, and vulnerable is critical, and having that understanding and that expectation between the two is critical. And then on a more sort of granular level, I would say the answer depends. What does it depend upon? The circumstance that that company finds itself in and the issues that you're dealing with at any given time. So I have unfortunately been in situations when board is reactive to cash crisis situation and you are literally needing to receive information daily, sometimes even more granular than that. That is the exception to the rule, unfortunately, but that is a fact. In other instances, it could be regulatory issues. It could be crises that have gone on because there was a death in the staff, or someone quit unexpectedly, or and on it goes. So it depends. In those sort of game-changing moments, board needs to know on an immediate sort of basis. Otherwise, depending upon the company, it could be just on that every month, maybe it's twice a month. There's some key indicators that I would like to stay in touch with so I can see those trend lines, so I can know and anticipate what the issues may be that we're going to be discussing and how we can navigate together.
So Morris, by definition, a first-time entrepreneur hasn't done it before. If we've invested at a seed level, they've raised money once, so that's one data point across the round. How do you help them, or how much help and structure do you try to provide when they then go out to this brand new world of courting VCs across the country who are used to seeing very different levels of detail and sophistication from entrepreneurs?
I'm not sure I accept the premise of the question, because in my mind, a founder who goes out and speaks to VCs only when they're getting ready to or raising money has waited way too long. Especially at this early stage of venture, the idea has a great deal to do, and the story to be told has a great deal to do with how much a venture funding entity or an angel is going to be interested. But ultimately, they're making a bet on the founding team. And nobody is going to be able to make a decision on funding quickly enough unless there's already a relationship being built. So in my mind, any of the founders that I work with, I want them out once a quarter talking to VCs and getting their advice and asking them what they think, and bouncing off them their current idea of how to run the company and what the business model should look like, and what they should be looking out for, etc. Because no matter how you slice it, the CEO and the founders are the only ones responsible for raising money. And in order to be able to raise money, they need to understand the market, and they need to build relationships. And they can't do either without being out there constantly talking to funding sources.
Scott, as it comes to relationship building and culture building with the board, what's your take on whether it's board dinners, events, getting to see and know a board outside of the context of this very rigid meeting or call?
I think I'm layering on my previous response, really. All for board dinners, lunches, discussions, something like that makes it a little bit more informal, but don't overdo it, or at least don't overdo the money spent on it, because it needs to stay within the company. But going out for a modest dinner or somebody bringing the good wines, not on the company dime, is a good thing, because then you can learn about each other, share things, and the more you know, again, the more you know about each other, the more open you're going to be with each other and more comfortable bringing up difficult discussions and difficult topics. I mean, it's a little bit like family. Yeah.
can I just add a quick anecdote on that one? The first time I knew I was in trouble on a particular deal that I invested in, which by the way was a very hot deal that ended up raising over $50 million and spending every penny of it before they went out of business, was I showed up to the first board meeting and the CEO was making a big show of how much he knew about wine and what great wines he had ordered for the board to drink.
And Bob's your uncle.
So Dan, a lot of these companies have 12 months of runway when you start. How do you hit the ground running as a board to try to have an impact, really, as opposed to getting 3 months, 4 months down the road and feeling like you're not on track?
So orientation for me, at least, when I'm stepping into a board situation, I'm going to want to understand some real core basics: product market fit, differentiators, uniqueness, competitive landscape, external factors that impact us that we need to be aware of that are out of our control. Things like that are critically important. I'm also going to ask for some basics that we all should be asking for: corporate minutes in board minutes from however many, a couple of years back, financial materials a couple of years back. Then looking forward, the forecasts and the KPIs and the standard blocking tackling type information so that you're up to curve and not starting cold. Then I'm asking questions. I don't know if it was Dave or it might have been Len, I can't recall, had talked about meeting outside of board environment. I want to call the other board members. I want to ask the CEO's perspective. Give me the landscape. What's it like in your boardroom? What's the culture like? What kinds of interactions are going on? Are there problems that you perceive that we need to be addressing together? Beyond that, what do you see as the burning issues that you're dealing with that are keeping you up at night right now? And what are you doing about it? And what are you using your board for? And how responsive and reactive and helpful have they been? I want to understand that dynamic as well.
Great. So one more question, then we'll go to the group. So Morris, besides board members, there's a notion of an observer. And lots of people want to be observers. So I won't be a board member, I'll be an observer. Maybe an old board member converts into an observer. Maybe you find out there's a side letter which you didn't know about which says 2 other people can be observers. How many is too many? And how do you manage that when people expect to be part of the conversation?
Too many is any person in the room that isn't adding value to the conversation. Again, observer seats, and now, I always take an observer seat. I always insist on an observer seat. And I always insist on information rights that are going to be very in-depth, because I can't offer good counsel without knowledge of what's going on in the company. So in my mind, not everybody should be an observer, but if you choose your investors properly, as a CEO, as a founder, then you shouldn't be taking anybody as an investor into your company that you wouldn't want in that meeting as an observer. I know that's kind of idealistic, especially when you are a company based in Northeast Ohio. But from a purely theoretical standpoint, and I advise all the companies I work with of this, you shouldn't have somebody investing in your company who you wouldn't want in that meeting and in that advisors meeting, because they can cause you far more trouble as an investor than they're going to cause you in that meeting room. So you'd better know who you're bringing into the room with you.
Okay. Questions from the group? Clay?
Just building more on what you were saying. An institutional VC comes into the picture. A company is anxious to have their money. How do you deal with the VC who, frankly, doesn't give a damn
I don't, but I advise the founder and the CEO, who ultimately is going to have to be the one to partner with this group. Number one, go talk to several companies that the VC has funded in the past that didn't work out the way everybody planned, and see how they dealt with that situation, and see if you're comfortable with that. I talk to the founders that I work with from day one and tell them, you know, I am here to support you. I am here to support the founding team. I don't represent the company. When it comes time to talk to VCs, I am here to advise you, not to advise the company on what is best for you, because in my mind, what's best for a startup stage or earlier company is what's best for the founders. Because my experience has been that if you need to replace a founder in a high-level role, the company's not going to make it past the early stage. And I can't tell you that I have not made mistakes on what founders I have backed, but I have never been in favor of replacing a founder. So my advice always is going to be to the founder, talk to the VC, due diligence of the VC, talk to CEOs that are in companies that were either living dead or otherwise didn't work the way they were supposed to. Talk to the companies that were in the portfolio that were acqui-hires or sideways acquisitions, and find out how these people deal with others. And my goal always is, my feeling is, as a very, very early stage investor, the only protection that I've got from abusive later VCs is the founder anyway. So it's not just because I'm a nice guy, although some people do think I am. It's not that, people sometimes call me an angel, but I'm not an angel. I got a fund, I'm in this to make money. My business model is to support founders because I believe that's the best way to protect yourself in later rounds and to make sure that the company succeeds.
Yes?
Morris, on that line, you alluded to the fact that the founder or CEO's responsibility is to raise money. And I'm wondering, though, how much is the board also responsible for fundraising, making connections, introductions, different than a for-profit billion-dollar company, talking early stage. I haven't heard that at all in any conversation, that if I'm a board member, I should be out there evangelizing for the company. Is that true or false?
That's absolutely true. And in fact, it is, especially in the case of younger, less experienced founders, it is not only the investor and board member, whatever you want to call them, responsibility to introduce them, but it is also their responsibility to steer them away from the vultures. And it is their responsibility to bring them, I've got a group of Series A investors that I bring people to, and that's one of the things that I like to be able to bring to the table. And that really is what an early stage, one of the most important roles that an early stage investor should be. I consider it my job, number one, to be a mentor and someone to support the CEO. And number two, my job is done when I have found somebody that the founder can trust and that I can trust to take the company to the next stage from a funding perspective and from a guidance perspective.
Well, if we have no other questions, I think we should proceed to the Angel's Envy giveaway, for which we'll need the help of the panel here. So Kishore has a list and a process here. I believe what we did, each one of our registrants has a number associated with them. Well, this is a different process. I think we're going for a number between 1 and 25 right now. Who's feeling lucky?
14.
I'll let you read number 14 if you can read that without squinting.
Guest.
Everyone's a
Randy Markey.
Hey! All right. Congratulations, Randy. Enjoy. And again, thank you everyone for attending. We hope you'll join us on September 12th for our next education session, Learning from Exits. Have a good night.